Molly, the downgrades, is there a concern about the use of cash?
Exactly. So Oracle's borrowing $15 billion today. It's roughly split between repaying near-term debt maturities, so maturing this year and next, and the rest to be earmarked for other general corporate purposes, largely share buybacks and dividends. So that's really where the credit raters are taking issue, that this is a really big amount of money to be allocated for shareholder-friendly proceeds versus they like to see that more allocated to debt reduction. And where Fitch actually took issue, which was kind of interesting since half of it is for debt reduction, is that they would have liked to see Oracle be repaying debt at maturity, as in not taking out more debt now to refinance debt coming due before that due date.
So, Molly, is this something that's going on elsewhere? Is Oracle the only one getting aggressive? Is anyone else, before we start to see yields go any higher in terms of the U.S. Treasuries and the benchmarks?
So that's what we're starting to see now, Caroline, is that there are more generally aggressive uses of proceeds in investment-grade bond sales lately. We saw a couple of M&A deals out of Canada recently. So today, coming from Canadian Pacific Railway, and last week from Rogers Communications. So both of those to be using a significant amount of debt financing to fund those deals. And this is where the proceeds are getting a bit more aggressive and not what bondholders like to see, because it increases leverage and doesn't really help bondholders at the end of the day. This is really mostly for shareholders' benefit. And that's where it's really stark contrast to what we saw for so much of last year. Companies just borrowing in survival mode, right? Like just adding to the balance sheet, just get that cash balance up. But now that we're seeing the proceeds are turning much more aggressive.
Molly, it's interesting, though. Caroline and I were speaking to Winnie Caesar, who's the Wells Fargo Securities head of credit strategy, at the top of the last hour, and highlighting, though, that corporate balance sheets, particularly within high yield, have never looked better. Where is the concern then about the health of balance sheets?
So this is more in the investment grade market that we're talking about, and
here, of course, I'm showing high yield, but you're good. You'll
exactly
migrate.
Right. So these companies are it's just showing a shift really in financial policy and to debt, and something that like these companies are not, at least right now, at risk of falling to high yield, and that's something that whenever you're taking on significant debt issuance like this, you are in contact with the rating agencies all the time. So Moody's and Fitch knew that this was coming today. They drew those downgrades right at the beginning of the day when the bond sale was announced. They're in contact with Oracle, whoever the issue is, before the bond sale comes. So the companies are definitely looking to protect those investment grade ratings, but just stretching in terms of what the rating allows for how much debt you can take on at that rating.